We're going to the next segment. I'm not going to take that 1 minute break at this point because we just had one. But at this segment right now, we're going to start looking at the FX market. So as I mentioned to you early on, we trade in currency pairs. And if you refer back to all those currency pairs that we're talking about, the US economy, the US dollar is one of the major currency pairs, major currency that we trade with, because the US economy can still drive and influence the performance of the global economy. It is still right now the largest consumer and the largest economy in the world. Okay, however, it is also important to understand the characteristics of other major currency pairs. So one thing you want to take note of is, a lot of times when I go through this one slide, people will ask me about China being the next biggest economy and all the other influences that will probably come into play in the future. But right now, we are still going to be focused more on the US economy. We've seen examples of how the different performance in the US economy can lead to different results in the global economy. So it is still the largest consumer-based and economy in the world. If the US does well, most of the time you will see a recovery lagging for the world economies. And if the US actually does badly, if something bad happens to the US economy, you could actually see, or you will actually see, it having a negative impact on most major economies or most economies in the rest of the world. So looking at the major currency pairs here, I want to focus a bit onto a few that I really like. One of it being the US dollar, Japanese yen, USD, JPY. Okay, this currency, US dollar, JPY, tends to trade in a bit of a range for a little bit of a time, for a short period of time, before it gets followed on with a large shift over a short period of time. So a range and then have a big jump upwards, or a range and have a big jump downwards. Okay. This range before that big shift is really because of that trade competitiveness between Japan and the US. Okay, it's a trade competitiveness with that range and the shift. With a weak yen, with a weak Japanese yen, exports is likely to increase because it makes things cheaper for people to export. But Japanese manufacturers and exporters are likely to feel the pinch in the long term. In the short term, it will make exports increase because prices drop for Japanese products. And as prices drop for Japanese products and as exports increase, the US markets are likely to be flooded with more Japanese products. And because of this, the US trying to protect its own productions in the markets, this imbalance is likely to be quickly offset by policy, both from the Japanese Bank of Japan and also from the US side, to either appreciate or increase the value of the Japanese yen, or to depreciate or to decrease the value of the US dollar, so that they can adjust prices of exports coming from Japan. So remember this, like most of the time, this move, as in the range and large shift over time on the US dollar and Japanese yen, is occurring because of trade competitiveness between Japan and the US. I'll give you an example. I'll show you a chart example here. You can see in the red boxes. Okay, you see in the red boxes, US yen. This is US yen on the weekly time frame moving across, and this actually applies all the way back to 2004. It moves across before that big move upwards. It moves across before the big move upwards, and move across before the move upwards. What I would like you to do is to use this example. I've identified a few examples where it's moved across and gone up. Maybe what you want to do in your own time is to identify a few examples where it's moved across and went down. You will see that it actually moves in a range before going lower, and this actually applies on many different time frames for the US yen. So this is quite an interesting exercise that you might want to do either on this picture if you have the file downloaded, or if you want to fire up your own charts and then actually identify situations where it's moved across and shot lower, or moved across and gone up. This is a big hint towards trading the US yen successfully. When you see it moving across, it should tell you to be a bit patient. There is likely to be a big move happening, either a lot to the upside or towards a downside move. This is also another reason why we say that the yen is a reserve currency. Okay, what is a reserve currency? A reserve currency or a reserve commodity is one which people would demand during times of uncertainty. What are times of uncertainty, or what are reserve currencies? What are reserve commodities? The US dollar is a reserve currency. Gold is a reserve commodity. Yen, as we have up there, is a reserve currency. Sometimes the Swiss franc is also a reserve currency. Reserve currencies, reserve commodities are in demand in terms of uncertainty. Demand for reserve increases during situations such as financial crisis. Best example was the most recent one in the GFC, where financial markets were crashing. We saw a lot of capital move towards gold as people seek that reserve commodity status, seek the reserve status, or seek safety. It went towards gold. War, right? If there's a situation of war in a particular region, you could actually see that move towards reserve. If it was a war without the US involved, you could actually see the US dollar increase as people start buying into the US dollar as a reserve currency, or people start buying into gold as a reserve commodity. Natural disasters are also another example, and most recently the pandemic. It's a very current example where we saw gold reach massive highs because of that reserve commodity status. With every uncertainty, we're likely to see capital move towards reserve currencies and or reserve commodities. Okay, so reserve commodities is gold. With commodity currencies are currencies typically considered as commodity-based currencies, as they are big exporters of various commodities, such as gold, such as oil, such as a lot of things that you can dig up or produce. Typically, commodity prices would go up. Economy in these countries will also do well because they produce those commodity. They will be exporting that a lot, which will lead to their currencies being appreciated as people would demand those currencies so that they can trade with those commodities. With those currencies, the major currencies that we trade, the three main commodity currencies that we pay attention to are the Australian dollar, which with the commodity is driven mostly by gold prices and iron ore. There are other commodities that could influence the Australian dollar, but not 100%. Remember that all these commodities are going to influence, but it's not going to influence 100%. Copper could be one other commodity that influences the Australian dollar. For the New Zealand dollar, gold again is going to influence the New Zealand dollar, and also dairy. Dairy could influence, price of dairy could influence the New Zealand dollar. And then for Canadian dollar, quite straightforward. It is going to be oil, price of oil that affects the Canadian dollar, right? So one point that I really want to impose upon you, and if you're taking notes, write this down, is that although the commodity currencies, although the commodity prices of commodities can influence the prices of the currency, it is not going to influence it 100%. It is never going to be 100%. What this means is, with this example that I'll be showing you, the New Zealand dollar, right? Gold and the New Zealand dollar, you would expect gold and New Zealand dollar to move together in the same direction. But in this example here, in 05 to 06, we have seen that the New Zealand dollar go down while gold is going up. Gold is in blue, New Zealand is in red. We can see that New Zealand dollar going down, gold is going up. That inverse relationship. Why did this happen? Mainly it's because of that earthquake in New Zealand in 2005, a natural disaster, right? So as a natural disaster occurs in New Zealand, we saw New Zealand dollar weaken, and we saw that move towards gold reserve. So we saw gold increase. In a normal situation, between 06 to 08, you would see that New Zealand dollar and gold move pretty much in tandem. Although you would see that also New Zealand dollar had a little bit more volatility than gold. It was moving with a bit more of a range than gold. In 08 and 09, again, you would see that gold continued climbing and New Zealand dollar dropped significantly, mainly because of the global financial crisis. Global financial crisis, again, another uncertainty, financial uncertainty that which caused that move towards gold, move towards commodity, reserve commodity, and that move away from New Zealand dollar. Okay, so this example here, if I move this back, this example here is really to show you that although we have New Zealand dollar and gold, and they are quite closely related, they can be affected by different events, such as earthquakes, such as financial crisis. It's not always going to be, if you see gold going up, you buy New Zealand dollar, or if you see gold going down, you sell New Zealand dollar. It's not 100% correlated. There are also external shocks that could influence price of gold or influence the price of the New Zealand dollar. Okay, so now we come to Euro US dollar, the Euro US. And this is actually one of the favorite currency pairs for most traders. Okay, the euro is actually a common currency for 19 countries. Common currency for 19 countries, and it has a very unique, I call it unique nature. Right? Why this is very unique is that all major currencies have to be determined by the central bank, the ECB, the European Central Bank, which means that while each country has its own central bank, the ECB has to make that decision across the board. So a lot of policies, a lot of things regarding the euro have to be approved by all member states. And this causes massive long delays, right? This policy formulation for the currency is a very difficult task, takes a long time, needs everyone to agree. Implementing one policy could be very, very difficult. So what actually leads to, it becomes that the Euro US is one of the most traded currency pairs for a lot of new and experienced traders. But because that one economic policy could take a very long time to implement, when it's implemented, it has a big impact across several economies. It's a big impact on the price of the Euro US dollar. Because of that, price volatility is the highest for this pair. And actually, because of that as well, prices move the fastest and the greatest for the euro US dollar across a lot of different other currency pairs. What this actually means is that you could be making big profits when you trade the euro US dollar if you're on the right side of the trade, but it also means that you're at risk of losing a lot if you're at the wrong side of the trade. And because that these policies apply across several economies, you need to have a very broad view of what could happen, what could be the likely scenario, what the risk you're taking on would be. At this point, I would always suggest that a lot of new traders, if you're a new trader, you probably should be avoiding the euro US at this point in time, or as a starting point in time, and trade other currency pairs first. Don't get too attracted by volatility because of the potential profits. Think of volatility and think of the risk that you could be taking on if you were on the wrong side of that volatility. So again, my best recommendation to a lot of new traders will be to trade something a little bit less volatile or something that trends a little bit better rather than the euro US dollar, as if you're new, as it has high volatility and it probably sits quite quietly before spiking up or spiking down within very short periods of time. Okay, so that's the euro US dollar. Then we have the pound US dollar, the UK pound against the US dollar. The pound, as we all know, the pound dollar is going through Brexit. The UK is going through Brexit at this point in time. And based on the recent uncertainty that Brexit has brought to the pound, we've seen a lot more volatility in the pound dollar. Previously, the pound dollar used to go through very nice long-term, medium to long-term trends, moving 6 months upwards or 6 months downwards. Okay, so recently they have voted to exit from the EU, but we have still seen the negotiations between the pound dollar, between the UK and the Eurozone, and it's been causing a lot more volatility because you've seen that 51% of the UK exports and 51% of the UK imports come from the Eurozone. So we're still looking at how that relationship with Brexit and the EU is going to come into play, and that could actually lead to whether the pound is going to move back towards its long-term trends or result in that big volatility over this period of time. All right.